Hello, my name is Josh, and this is Finance Soup. And today I wanted to touch on something. I was going to use Beyond Me as an example, but something about the difference between traditional value investing, which I think is broken, and what I think of modern day valuation. So I watched these. I recently saw a video by the Everything Money channel who they've taught me some things, but honestly, I'm not a fan. I find them far too conservative, and this video sums up why they are not the best, and I would not recommend watching them unless you're a very big beginner. So again, they can help you understand the basics, but let's just watch the clip.
Like our stock analyzer tool right here that we use for our software. First off, 8 pillars, not enough data. Stock analyzer tool, it's useless here. Why? Because the company is losing money. Our stock analyzer tool is for companies that are making money, that have a, because remember guys, the future is unknown. That's what makes investing hard. The future is unknown. But you've
That's true. The future is unknown, but you know it's always unknown. But he basically goes on to say that um, their tool and their software, they're good at analyzing companies that are stable and well understood. He uses the example of Microsoft. Oh, Microsoft, I can give a prediction of what Microsoft's going to make, but so can everyone. And now with computers and all this, it's so easy to model a company that's stable. And this is what I call the value trap. The value trap is all the same value investors say, oh, look, this company's stable. We've analyzed it, and it looks like it's priced below the market. Well, we should buy that. What they don't see is all the other things. It's hard to see the future, but one of the reasons Intel, they're a big believer in Intel, is trading significantly lower, and they say, oh, but still good buy, is because the world of microchips is changing. More and more companies like Apple, like Tesla, are taking um, manufacturing in-house. That's really going to hurt their sales significantly. Meanwhile, other teams, NVIDIA, AMD, are eating their lunch. They are not seeing the future. And so, yeah, it's easy to predict, oh, look, if they just, continue to produce like this, they're a steal. No, that's not how it works. I mean, maybe they do. And if they do end up squeezing out continued revenue growth, then they'll do well. But you can't just model it without looking at the world. That's why I say it always has to start from a logical framework. You have to understand the business. So here they go on. Here, let's finish the clip.
added another layer on top of it. The past is not justified. At least with companies that are established, we can sit there and say, hey, I can give a reasonable range of what I think Microsoft will make in the next 5 or 10 years. Will I
Yes,
be 100% right? No, but I can give a reasonable. I have no clue what Beyond Meat will make in the next 5 or 10 years.
and that's the point. He is that most people with a reasonable estimation can say, what has Microsoft done in the last 5 to 10 years? He says, I have no idea what Beyond Meat. Well, that means it's tough. But here's the difference. When things are tough, that's where the most money is made. The most money is not made when everyone sees it and it's obvious. Everyone knows Amazon's a great company. But if you invest in Tesla, you made a ton of money. Why? Because there were so many people that didn't believe in Tesla. You have to go against consensus. That's where the biggest winners are. Now, again, I'm not saying pick something against consensus just for the sake of it. But again, you have to understand that when things aren't seen, or are harder to model and harder to judge, that's where the most upside is. So again, he talks about Beyond Meat and he doesn't even give a number. Normally they give a number. I'm done with these guys now because of this. Again, you can always come up with a number. So I wanted to use that as an example of how I would come up with a number. I gave a quick range the other day. Let's just go in. So one, we can look at revenue and revenue growth. So we can say, hey, you know what? They made $500 million last year. If you really want to break in, at one point I was a big Beyond Meat investor. I sold out when it went up. Here, let's actually look at the stock price. I think it was around here. Not quite, but I think I sold at 160, 170. It was this time 155. And I sold out of it and I said I'm done. And you can see there's been a pretty clear trend line down since then. So I'm happy. I put my money to better work. But to say you can't estimate is just false. So they've had very strong growth. They have two main ways of growing. They have in grocery stores and in fast foods. And fast foods saw a big pullback during COVID because things were shut down. That started to reaccelerate. So you can see like huge growth numbers, 169, 238, and then suddenly they had significantly slower growth. I do expect that to pick back up again, though there are risks. Again, will they continue to grow as they push out new product lines? That should probably help. But there's also Impossible Meat. That's competition. There's other companies that are coming out with their own plant-based ones, and there's new brands and companies. I've seen here in Canada, Light Life is one that's taken up a lot of share. So there is competition that could slow growth. Again, I'm not trying to predict what growth will be. I'm just saying we could make assumptions. I might not be right, but again, this is where the most money can be made if you can really predict and see these trends, especially if you're early. If you saw this early, you'd be making tons if you're an early investor in Beyond Meat. I mean, like before it was IPO'd. Okay, now let's look at their margin profile. Again, their margins are at the top, it's been about 35. Now it's about 28. Obviously, operating profit, they're not making any right now. But that's because they're spending money to scale up productions and for marketing and all that. And we're trying to say what long term could their margins be. I think this is something where with scale you actually can get some operating leverage. With a food processing plant, like there's cows and you kill them and you process them. I don't think you get as much operating leverage as this, which is very much automated with the plants. Or I think there's a little bit more. So with Tyson Foods, we can see their gross margins were previously 6%. Now they're all the way up to 13%. So again, Beyond Meat already has a huge advantage over them. Um, and they're making about 7% operating profit right now. This Tyson Foods, an actual food processor for real foods. So to me, I think this would be on the low end. We could say, okay, long-term Beyond Meat, low end could probably get to 7%. I think it's more likely they can get to 10, 15 even. I think 15 is a reasonable assumption. Again, this is what we're doing. We're making assumptions about the future, and based on those assumptions, we are going to put a price on it. Now, again, some people say, you know what, my assumption, let's actually go here. So let's go to Finbox. They have a model here. What's the terminal value? Grows 2.5%. They say it'll grow at 25% per year on average over the next 10 years. They say the average margins will be 18.5, though they see them actually going up much higher in the long term. Again, is that reasonable? Maybe, maybe not, but they still see it as being worth less than it is today based on that. And, to me, if you're less sure about your predictions, I would just slap on a higher growth rate. So let's say you think, you know what? I actually think they'll reaccelerate growth and they'll grow at, they were growing at 180% or something last year. What was it again? They were growing at 238% from 2018 to 19. Huge growth rate. So let's say you think that picks back up after COVID and you got 80. Okay, now you see, oh, look, there's some upside. Maybe it's discounted. However, you say this company, I'm much less sure about the margins, about the growth. And so because of that, you slap on a higher discount rate. A discount rate, I slapped on 10% now, and you can see now there's downside. Again, this is not me saying that I would recommend buying Beyond Meat. I personally think it's overvalued. I would buy it. But if you want to put a speculative play because you really think you see a lot of growth here, I wouldn't be opposed to it. And that's my point. You can make any number work based on the assumptions you have. With a company like Microsoft, the assumptions are very obvious. Oh, look, they've grown at 17.5% over the last 20 years. That's probably reasonable. Their margins are 35%. That's reasonable. Obviously, it's unlikely they're going to drop to 10% margins, unlikely they're going to go up to 80% margins. Are there things you can tinker with around the edges? Yeah. But when a company's well understood and easy to model, everyone can model. And so you get a very narrow range of outcomes. And when that narrow range, that means, everyone basically has consensus. Yes, Microsoft's worth about $300 a share or whatever. Beyond Meat, because there's so much uncertainty, you get a huge range of outcomes. Some people are going to say, you know what, I think it'll go up, I think we're going to see huge growth, 70, 70, 60, 50. I could make this work if I really want to. Now, I'm not saying you should, but if someone really says, you know what, I really see them not just getting into this, I see them, the future of meat is going to be like this, and it's going to be international, and, I think 30% of all food is going to be plant-based. Again, I'm making it up, but, you could Google what's the size of the meat market, what percentage of it do you think it's going to capture, and bam, you could even do that with, what's Tyson Foods do, which is like, I think they represent about a quarter of the market. Okay, they have 45 billion. So if you think let's just say they have 45 billion. Let's say they're about a quarter of the meat market in the US. By that logic, the market would be 200 billion for meat. Let's say you think fake meat can get to, let's do some quick math. Again, this is not advice, but this is how you have to think about it. You have to have a logical framework. If you think the meat market in the US is worth 200 billion, and you think that that fake meat will represent 10% of it, then that would be 90%. Then fake meat would be worth, or plant-based meat would be worth $22 billion. So then you say, what percentage of that do you think Beyond Meat could capture? Let's say you think they'll capture 40%. So that'd be 8.8 billion. Okay, 8.8 billion, and currently they made half a billion. So 8.8 billion equals over half a billion. So that you think they're going to grow 17-fold over the next 10 years. That's an average of 33% growth per year. And when we look here, what is this? This is 39, so this is a little higher, but let's scale it back a little. But the point is, like, you can get to these assumptions with reasonable assumptions. If you really believe they're going to be 10% of the market, and that's how much the market's worth now. Maybe you think that the market gets bigger and they could get, maybe it's worth more than 10%, maybe it's 15%. Maybe Beyond Meat has a higher share of the market, maybe it's lower. Again, these are the assumptions you have to make. Maybe you think they have more margins. Um, but because Beyond Meat has less certainty, there's a much wider range of outcomes. So you could believe it's going to be worth $50 a share right now, or you could believe it could be worth $200 a share right now, based on your assumptions. And because of that, there is opportunity for people who can accurately predict where it's going. Now, again, I don't think I can in this market. I always try, though, to look at markets where I do have an edge, and I think I can predict the future to an extent of where are we going, what's pushing this forwards. And again, you want to have reasonable assumptions. But again, like Tesla, is the world heading towards electric vehicles? For sure. And I thought that was so obvious from the time. And when I bought Tesla, it was, let's look, down around here. This is split adjusted. So at the time it was not $50. I think it was a couple $100 a share, $300. I bought it at the two. I know I bought when he smoked weed with Joe Rogan. That was about 280, I think. To me, the risk reward there was this is going to grow. Now, did I think it would go up to this 2,000% in this quick a timeline? No, I had no expectations of that whatsoever. I had no idea. But I said it's so obvious that that the world is moving towards EVs, and Tesla is going to be the biggest beneficiary. If you looked and said, hey, I think EVs in 30 years are going to be 50% of vehicles even, which is, I think it now is going to be even more. And this is at the time, and you think Tesla could even get to 5 or 10% of that market share, then this was an easy investment. And that's the point, is that's why there was so much opportunity with Tesla, because people had such varying ranges. Some people thought it was going to 10x, and some people thought it was going to go bankrupt. And that's why there was opportunity. And if you invested, here you made money. Now, maybe there's an alternate universe where Elon Musk isn't, he dies or something, and it didn't work out and it goes bankrupt, and the people on the other side made money. But these stocks, where there's less known, have much higher risks. So just be aware. Beyond Meat, I do think, is a much riskier stock than Microsoft. There's a much higher chance that you're going to 10x your money with Beyond Meat, but there's also a much higher likelihood that you're going to lose 80% of your capital. So again, this is not a recommendation of Beyond Meat. This is just understanding the framework of how to understand investment and why I think value investing today is broken. I think all they do is they look at the numbers. And that's the funny part, though. You can make the numbers work if you really want to, if you believe in the growth, but they always use super conservative numbers, and they don't think anything's going to grow or scale. And so to me, you can always put a value on something, but it has to be based in logic. You have to say, why do I think this is going to grow? How much do I think it's going to grow? I posted a video on, again, if you said, oh, I think this is going to get to 100 billion in revenue, well, I think you're out to lunch, because, currently, if we're approximating that the market for all food is 200 billion, again, this is very rough math that I did in 10 seconds, so I could be wrong, but if you said it was $1 trillion, you think Beyond Meat's going to be worth, again, that seems crazy because How big's the market for meat, for example? So again, it has to be based in reality, but using very basic data, you can have a logical framework with, okay, how big's the market? How big a percentage of the overall market for food is this? And then what percentage of players is going to be? So you could do the same with Spotify. How big's the market for music streaming going to be? How much is Spotify going to get? How are they going to monetize that? Those are very basic understandings. If you have a very basic understanding, you can get a range. Again, the range isn't going to be perfect. The goal is never to be perfect, but it's to see, am I in the right ballpark? And what's the upside that I'm playing for? That's how I look at it, is what is the upside that we're playing for? Because I'm not in it to make 6, 7% a year. I'm in it to make 15% a year. Now, getting 15% a year means you're going to have some huge ones that make 50% a year, 20% a year. And it also means you're going to have some losses. So you want to have some downside protection. You don't want to lose 90% of your capital. That hurts. But you know that not all these are going to work out. So you do want to have, again, a logical framework and and understand the risks of any of these high flying companies and high growth companies. So those are my thoughts on valuation and tied specifically to Beyond Meat. My name's Josh. This has been Finance Soup, and thanks for watching.